This is definitely a video you want to keep in your trading back pocket, especially if you think cryptocurrencies, Bitcoin, are going to fall further in price. How do you take advantage of a market such as cryptos or Bitcoin falling in price? Well, that is called short selling, and in this video I take a look at the short selling process and how in the cryptocurrency world you can actually short sell. Hello, I'm Stephen Ho, trader and founder of The Stop Hunter. Before I carry on, a quick risk warning. All trading and investing, especially cryptocurrency trading, because it can be very volatile, is very risky and can be very damaging to your wealth, and all your funds are at risk. So always do your homework. Always seek professional, qualified advice from people such as financial advisors, and always be very careful. So with that, let's crack on. So here's the scenario. You've bought a stack load of Bitcoin and they've been going up nicely, and then all of a sudden the price has tumbled, and this happens a lot in Bitcoin, and you see it go down 5%, 10%, 20%, down to 30%, and you are pulling your hair out and you're wondering, what can I do? And you're also wishing that you could take advantage of that price falling off massively. And yes, there is a way you can take advantage, and it is called short selling, and it's available to all investors. It's just as risky a process, I believe, as buying the asset and selling, and this process is selling the asset. So if you understand what you're doing, you understand the process, then I think it's a very useful tool to have, like I said earlier, in your back pocket for just such a situation as a big market sell-off. Or you can turn it into short-term strategies when, for whatever reason, that brings you to the point that you think that the market for, say, Bitcoin is going to fall. And that could be technical analysis, fundamental analysis, a gut feel. It could be some regulation thing. It could be a fork in the cryptocurrency. It could be China restricting certain things. It could be Elon Musk saying, whatever it is, you've come to that point where you think the price is going to fall, and then we need to be able to short sell. But before I give you, I think, the three main methods of doing so, we need to just a bit better understand what short selling is. Short selling is a trading method that allows you to benefit from drops in price of the asset you are trading. Now, in this video, we're looking at cryptocurrencies, but it's very, very common in the wider world of financial markets, in forex, stocks, commodities. It's very common practice. But the basic process is you borrow an asset from your broker or exchange, and then you sell it at the current price, and you hope through your analysis that that price falls, and you then buy it back at a later date for a profit. So if we made up a hypothetical example on Bitcoin, say we sold at 38,000 right now, and then a month later we come back and the price is at 28,000, we then therefore have made 10,000 points of profit. So that really is the basics of short selling, and I'll put a link for new traders and investors at the end of this video for you to follow. Another video that I produced on going long and going short, so you can get a bit of a better understanding and a bit more detail. So now let's move on to the three methods that are currently available for the retail trader to take advantage of this short selling process. Now, the first one is using something called contracts for difference, and they are abbreviated as CFDs. You might have heard of that. And in the UK, you could also use something called spread betting, which is very similar and gives you tax-free advantages. But a CFD is essentially a synthetic or copy contract of the real thing, and it's just really dealing in price movement. You're not playing around with the physical asset at all. So what you get paid is the difference in the price. So if you think, going back to our example with the 38,000 sell of Bitcoin, and it gets to 28,000, and you've put £1 per point on that move, you might get £10,000 worth of profit. You are essentially paid the difference in price in our example. And you could use someone like City Index, and I'll put a link in the description below if you want to see what they can offer. But there are many brokers out there that will offer that CFD type contract. So a quick warning on CFDs: they are a leveraged product, and that means they can be more risky to the downside. They can make you faster returns, but you've got to bear in mind the risks involved. And leverage, and I'm going to do a video on this in the next week or so follow that as well, so you can get more of an understanding. But essentially it's the broker giving you a multiple of the amount you deposit in their account to play with. So if you put £1,000 down and you want to trade cryptocurrencies, you want to use that full £1,000, they might give you a ratio of 5 to 1. So that means you can play with £5,000 on that same trade, and if you lose it, the trade goes against you, you owe the £5,000, not the 1,000 that you initially put down. So got to be very careful. Like I say, it's good to the upside, but can be very dangerous to the downside. So beware of the leverage product and understand them before playing with them. Our second method of shorting or short selling cryptos could be via one of the exchanges, Bitcoin exchange, and they're not so common or accessible as, say, a CFD account that you could get in the rest of the world. But because you can't do CFDs in the US, this might be your option there. And companies such as Binance, Kraken, Bitfinex, BitMEX allow you to short sell, and they can also offer leverage. So be careful, just like the CFDs. You don't have to accept the leverage. Don't get greedy if you don't understand it. But essentially the same process as the CFDs. You borrow against what you've got on account to sell short and take advantage from that downward move in price. And our final method is a bit more complex and maybe for the more experienced, and that is using something called futures and options. And these are derivative products of the actual underlying asset, and it could be, in this instance, Bitcoin or Ethereum, and they allow you to go short as well. And if you get really into this sort of thing, you could buy a put option to take advantage of a falling price. And again, these are complex instruments. They offer you leverage, and the option, for example, gives you the right but not the obligation to trade at a specific price by a certain expiry date. So it's an interesting one to get involved with, and people you could possibly trade these with are people like BitMEX, TD Ameritrade, eToro, Kraken, people such as that. So there you go, 3 methods to take advantage of a falling cryptocurrency market. We looked at CFDs, /spread betting, on exchanges, cryptocurrency exchanges, or using more complex financial market products such as futures and options. So let me know in the comments below if you short sell any of these cryptocurrencies. What experience have you had, and what brokers do you use? Are they good ones or bad ones? Let us know in the comments below. Also watch out for other video content around leverage and the short selling process in my channel. And I suppose really short selling is all about knowledge and experience and understanding. Once you know it, it's as safe a way as trading as going long, buying the asset. So it really is a valuable tool to have in your trading toolbox. So if you liked today's video, please give us the thumbs up. Don't forget to hit the subscribe and like buttons to receive further notifications around content such as this or anything else I'm going to produce in the near future. So all that's left for me to say is thanks for watching, good luck with the trading, and I'll see you in the next video.